Program is for informational and educational purposes only. This program is not a solicitation or recommendation for any investment or security. Investments or securities mentioned in this show may or may not be owned by NEPSIS Advisor Services. NEPSIS Advisor Services is an SEC-registered investment advisor.
Welcome to Journeys with Joni. My name is Joni Rametta, and I'm joined today by my co-host, Mark Clark. How are you, Mark?
I'm awesome, Joni. How are you today?
I'm good. We have a guest in the studio with us today.
We do. I'm excited.
It is exciting, isn't it?
We are. We're going to get educated today.
I hope so.
He's rolling his eyes at me.
Yeah. I'd roll my eyes at you,
Who
too.
is our guest, Joni?
Our guest. How are you?
Good, Joni. How are you today?
I'm good. We have Joe Rockline from Suppley and Shea, and you are a certified
public
accountant, CPA. I almost hesitated there because it's like, what's CPA stand for, right?
My wife could tell you.
I bet she could.
And you've been in town for let's just sort of talk
early 70s.
Yeah, let's sort of talk about
Joe.
Joe and who Joe is and why Joe's here.
Joe and I have a long-standing history together. We go way back to high school. So, and he's still my friend, which I can't believe. You know, I pay him well to be my friend. I'm just kidding.
Costs a lot.
I'm sure there's some stories from high school we can
we
talk
can't
about.
We don't
Not
have
on the air.
time.
We don't have time.
And our kids might be listening. We can't do that.
That's true too. Well, you know, the purpose of Journeys with Joni on the radio is to educate people. You know, Mark and I have a passion to get people ahead of the curve and trying to do some things prior to having issues. And part of that is, you know, this month in November, we're talking about giving. That's our theme for the month, as we've always had a theme every month for the last couple of months.
And we're coming up on Turkey Day.
And we are coming up on Thanksgiving, and that's a time for all of us to talk about all of our blessings and stuff.
And eat.
And eat.
You can't forget the eat part of Thanksgiving.
No, you better go to Publix and get your turkey pretty quick here. But we wanted to bring Joe in to answer some questions. We've had a couple of questions come in from listeners that we've asked for in the past. And so we wanted to get some planning things into everybody's thought processes now before the end of the year, because once, as we've said before, once December 31st comes, it's too late to do anything for the year. Isn't that correct, Joe?
Pretty much.
Yeah.
Pretty much.
So,
you want to get with your tax advisor now.
Right.
As soon as you can.
So before we get into the
he
detail,
likes what we keep saying. That's
I know
good.
He does. Tell us about the firm, Joe. It's Suppley and Shea. You guys are in downtown Sarasota, but tell us a little bit about the firm. What does the firm look like? What specialties do you have?
We're on the corner of 41 and Osprey, across from P.F. Chang's. I'm sure everybody knows where that is now.
We do now, yes.
We've been in business since '57. One of my partners, Norman, his father came down from Pennsylvania and started the firm. I've been with the firm since '85. Been a partner since '94. We have roughly 25 staff, including admin and secretarial staff.
It's a friendly staff too.
Yes, it is.
They always pick on me when I call.
That's a good.
But I get picked
I've
on
told
everywhere.
them ahead of time to do that.
That's awesome. And you do business and personal tax returns, right?
Business, personal, estates, and trusts. We do audits. Tom Kramer is our audit partner in the office. He handles a lot of the nonprofits locally, and Ray Suppley and Norman Shea are the other two partners in the office.
Excellent.
Mostly handle tax.
So you guys can handle pretty much everything. And I know one of the things that our firm and you in particular have been involved in is some pretty cool planning. And you, as a CPA, I know the general public thinks of a CPA or an accounting firm as reactive. And we'll talk about this later. Joni's getting nervous. I'm going ahead on my notes. But we typically say we bring you our stuff and you fix it. But you love the planning side of getting ahead, which is kind of where we're talking about, of sitting down with someone like you, if not your office. And by the way, we'll give out your contact info here in a few minutes. But that's a plus that you like to be involved on the planning side.
Well, we have to. You can't do anything after the barn doors open and the animals are out in the barnyard. There's a lot of wealthy individuals in the area that need to plan ahead of time with the Portability Act for estate planning and how much can be transferred to the spouse and then so on down the road to the children and their grandchildren.
Right. We've often referenced on this show the term "render under Caesar that which is Caesar's," and the follow-up to that is, "but no more."
Right.
And that's
as little as possible.
As little as possible, and that's the power of working with your firm and you is knowing what the rules are and using all those rules to the clients or if I'm the client, to my benefit, so that I'm in the best maximized situation for myself and not giving tax money to the government.
Mm-hmm.
I could go somewhere with that one,
Uncle
but
Sam.
I'll behave myself, Joni.
Mm-hmm. Thank you.
I don't want to get in any trouble.
No.
But planning, you do love the planning side, and some of the things we've been working on have been pretty cool, and it's nice to have an opportunity from your side. I know people always walk in and expect you to work magic out of that shoebox or pile of stuff that they give you.
Which is hard to do when you don't plan ahead.
And you're not a magician, correct? I mean,
Correct.
We're not magicians with making money.
Right.
So he's not a magician with not paying taxes.
Right.
Yeah.
You have to do it before the end of the year, not in February or March when you bring in your information, because at that point, most of the time it's too late.
Right. And that's why we're having this conversation today. Mm-hmm. We're coming up on Thanksgiving in a couple weeks, and people get into the holiday mode, and the next thing you know, they blink and, they're having the New Year's party and going, maybe I should have modified something or done something different. I have an opportunity now today, being here in the middle of November, we have the opportunity to make an impact versus waiting till after the party hats come off, we're toast, or the animals are out of the barn, as you put it, Joe.
Mm-hmm. So what do you like about planning? Like, if I were to come into your office today, what are some of the kind of things that we would probably talk about real quickly about, between now and the end of the year, things that, a couple bullet points maybe that you would make sure that I had done or hadn't done?
Well, we talk about some of the things that are available, especially if you have a business in place, and whether or not you're a cash basis taxpayer or accrual basis taxpayer, that would make a big difference on what we could write off. Mm-hmm. From a cash basis perspective, you can write off only what you actually struck the check for.
Right.
Whereas on an accrual basis, you could get invoices in from vendors and book that as an expense in this year, even though you might not have paid the bill. So if you're thinking about making that large equipment purchase that you want to place in service before December 31st and take Section 179 and be able to write all of it off or the majority of it off, as long as you have it in service but you haven't written the check for it, you can still write it off by the end of this year.
Right.
So that's one strategy. I know we're coming up on a break here. That's an awesome strategy, especially for those who are business owners. Mm-hmm. So Joe's talking technical. I love all this stuff because the power of what he can do with the tax planning is pretty awesome. But give out Joe's contact information before we go to this break, and we'll kind of pick it up afterward and talk about some more strategies. How do people find Joe?
Joe, it's Joe Rockline. It's Suppley and Shea. They're located at 800 South Osprey Avenue, and his phone number is 941-366-3600. And you can also reach him through us if you'd like to at NEPSIS Advisor Services. We are at 6230 University Parkway, and our phone number is 941-361-1484. Journeys with Joni. We'll be right back.
Do you know what you own and why you own it? Join us for our next workshop to learn about investing with clarity by calling 941-361-1484 to reserve your seat today. Joni and Mark look forward to discussing the philosophy, strategy, flexibility, and transparency, the 4 pillars of investing, with NEPSIS Advisor Services. Call today, 941-361-1484. That's 941-361-1484.
Welcome back to Journeys with Joni. Just before the break, Mark, Joe, and I were talking about planning for taxes now versus after the new year has rung in.
After the dog is out of the barn.
Yeah, well, that's what Joe said. The animals are out of the barn and out in the field. Isn't that what you said, Joe?
Yes,
yeah.
I did.
Yeah, that was really good. I've never heard that one before. But before we go any farther today, because we've got a couple of listeners that have given us some information and some questions that we want to ask Joe. But before we do that, the month of November for us, for Journeys with Joni, is we're giving away The Treasure Principle, a book written by Randy Alcorn. You have to go to www.journeyswithjoni.com to register your name and address, and we'll send you out the book.
We're not selling you anything. You don't,
No.
going to bug you to do that. Just come register and get the free book. It's a great short read. It's one of those books that, we are talking about giving, and we got a lot to be thankful for. Just the simple fact that we're able to get on the radio and talk about the things in the format, oftentimes with passion, the way we want to talk about them, is a freedom that we have. So there's a lot to be thankful for. And this is a great book. Those of you who have adult children or high school age young people, this is a great book to read and pass on to them. Yep. It's just a wonderful
we'll send it to you,
piece.
But we'll send it to you, but you can absolutely pass it on to other people.
Pay it forward.
Absolutely.
But we have Joe here, right?
We do.
Joe Sapli and Shea. Joe, give them your phone number.
941-366-3600 is our local number.
Great, downtown Sarasota. And we were talking about strategy before the break. And Joe, do you have, just to kind of throw it over to you, I got some lead-in questions, and I know, Joni, you've got some questions to ask him, but what's the hot topic that you have people calling in and asking you questions about with the buzz of Obamacare and the election and all the things that are just going on? What's the nervousness or the questions that are being asked?
Well, the biggest thing has to do with the employers, and they, that part of it got kicked off to 1/1/15. It was supposed to come into effect 1/1/14. Right. They pushed it back because they realized that they couldn't get it all initiated at one time. Mm-hmm. So the biggest thing coming up at the beginning of this year is the small employers, it really doesn't affect. They're exempt from the penalty tax. The large
small employer is how many? 50, how many employees?
Less than 50.
Less than 50
full-time employees. And they define a full-time employee as somebody that works an average of 30 hours a week or more.
That's not me.
You better not tell your wife that.
Yeah, really.
That doesn't count golfing, does it?
No, it doesn't.
Yeah.
And then the larger employees are over 50 who actually show up and work, right?
50 or more.
Okay.
And that it affects them if the employer's not offering the minimum essential coverage.
Okay.
They'll be assessed a penalty.
So people are having a lot of questions of what if, right? Or what's
right. And it affects every employer differently, because they may have a certain number of part-time employees, and what the definition is a full-time equivalent. And so you may have 15 part-time employees, and you may have, say, 45 full-time employees.
Right.
Well, if you run the math, those 15 part-time employees might kick you over the 50 number, and you still may be subject to that penalty.
And who's subject to the penalty then? It's the employer, not the employees, right?
Correct.
Okay.
Correct.
That was a question that we had from a listener, who's affected by those penalties for people who are working for small businesses. As I am the employee, or is my employer liable for that?
Right. Now, on the flip side of it, this year, there is an individual penalty that you have to have a minimum coverage. Mm-hmm. And if you don't, then we as the tax preparer will have to police that on the tax return. It'll be an additional tax on the return. So we'll have to ask certain questions to find out whether or not they have the proper minimum coverage. And if they don't, then we'll have to stick them with the penalty.
So when I bring my box in of things to do, I'm going to have to bring you in my insurance information as well.
Please don't bring the box.
Yeah, I'm just kidding.
We'll have flowers.
I won't bring a box.
You should have some sort of a form that says that you have the minimum essential coverage, and that would either be from your employer or from the insurance carrier that you've gotten your coverage through.
Right.
If you're self-employed and you've gotten your own coverage.
So to all those self-preparers out there who do their own taxes,
right?
Yeah. This is me speaking. This is not Joe. This is like doing your own brain surgery at this point. It's not that if they goof and make a mistake, they just get their hand slapped anymore. It can be a sizable financial penalty if they mess this up or don't correctly report, correct?
Right. The first year is minimal, somewhat minimal, but gradually it will increase so that it will be more than just a slap on the hand over the next 3 or 4 years.
Right. So it's definitely something you want to get some expert advice, help, and assistance with, because it's
well, and it's a penalty too, right?
Right.
Mm-hmm. So a penalty is not something you're ever going to get back. I mean, once that money's gone, it's gone.
Correct.
So as we're talking about planning and keeping more of what we earn, giving something away in a penalty doesn't make a lot of sense.
Right. The penalty amount would be the greater of 1% of the household income that is above the tax return filing threshold for your particular filing status, or a family flat dollar amount of $285 would be the maximum penalty. But it will significantly increase over the next few years.
I can eat at P.F. Chang's for $285 several times.
A couple of times, right?
Yeah, so $285 is still, I don't care who you are, it's $285 is $285. And
Right.
going back to the render Caesar, what's Caesar's, that's not his money. They're not spending it very well anyway, but that's a whole nother show. But nonetheless, get it right. These are the neat things that are happening that you've got to be aggressive on, and you have an opportunity to do some planning. So did you have another question before we ran into the break, Joni?
No, actually, I don't.
You don't have another question?
No, I
know
don't.
you do. But one of my notes that I have that we wanted to talk about is at the end of the year, this is Giving Month, and we're giving away the book, The Treasure Principles. Jump on the website, journeyswithjoni.com. Get your free book. But giving, we've talked on this show before, Joe, and maybe we can carry over into the last segment of our show after the break. We've talked about a donor advised fund, and I know you have people, I know we went from talking about the Obamacare penalty, but giving, people that say that you're doing planning for, that, you know, the last week or last several weeks of the year, you're saying, yeah, you need to give some money away because it's a tax planning strategy. And one of the things that we want to talk about after we come back is the ability to coordinate a donor advised fund so that they're not running around trying to figure out where to cut that check. Mm-hmm. So that's something that I know is of interest to a lot of people. So give out your contact information real quick, Joe, and then we'll come back to after the break and talk about some more goodies.
It's 800 South Osprey Avenue in Sarasota, and the phone number is 941-366-3600.
Journeyswithjoni.com. And what's our phone number?
Our phone number is 941-361-1484. And if you go to journeyswithjoni.com, you can register to receive a free copy of The Treasure Principle.
No string attached.
Actually, it's a very good book, and it's something that, you know, the holidays are coming up, so it's actually something you can share with other people around you. Give us a call or stop by our office. We're located at 6230 University Parkway. Journeys with Joni. We'll be right back.
Do you know what you own and why you own it? Join us for our next workshop to learn about investing with clarity by calling 941-361-1484 to reserve your seat today. Joni and Mark look forward to discussing the philosophy, strategy, flexibility, and transparency, the 4 pillars of investing, with NEPSIS Advisor Services. Call today, 941-361-1484. That's 941-361-1484.
Welcome back to Journeys with Joni. Just before the break, Joe, Mark, and I were talking about planning for the end of 2014. Talking about some of the things that we all need to be paying attention to. Are we not?
Absolutely.
Talking about Obamacare and employers and some of the penalties that are coming into effect starting in January, and how people should be getting their ducks in a row now.
I had a joke there, but I'm going to leave it alone. We're also giving away a book, right? I'm getting the evil eye on the radio. If you could see us in the studio, I'm getting the look. We're giving away a book, The Treasure Principle, a great book by Randy Alcorn. So we've talked about it several times. It's free, no string attached.
Yeah.
But the ducks, get your ducks in a row.
Uh-huh.
We're talking about planning for 2014 before you run out of time. And that's
Right.
why we have Joe here.
Absolutely. Because Joe's got some things that he's been talking to people about. And just before the break, during the last segment, he was actually talking about business owners and Section 179,
right?
Business equipment. And during the break, we were sort of talking about that a little bit. And there's actually some changes.
Yeah.
So we need to let listeners know that if you're a business owner, you need to pay attention to this stuff. There's still time.
Yeah. Unfortunately, this year, the limit to the amount that you can deduct is $25,000. Last year in 2013 was $500,000. And one of the areas that you can take a look at as a business owner is at the beginning of 2014, the repair and maintenance regs require that the business owner come up with a written policy of a specified dollar amount, or based on the useful life of the asset, that they can write off in the year that they buy it. So you could try to combine the lower limits of $25,000 deduction for Section 179 with maybe some additional tangible property that you could write off, whereas you might not have been able to write off all of that tangible property in the prior year. You would have to depreciate it. But if you set a limit this year, you could potentially pick up some more deductions this year by the end of the year.
So if you're making that big purchase, or you've made that big purchase in this year, you got some opportunity to do some planning.
Right. Exactly.
Before it's too late, and you take the party hat off 12/31 at midnight.
Right.
Well, I think it's really important that business owners, before they do, big things in their businesses, that they talk to their CPA, their accountant, to get advice prior to, because, currently we're working actually with a client that's looking to buy some equipment, and that's exactly what we're doing, is we're looking at, how do you purchase it, and what's the best way to do it?
What's the most tax efficient way to make the transaction? And that's a key. And what you're saying too, Joe, is once the horse is out of the barn, or all the animals are out of the barn, it's too late.
Right.
Yep.
And that's not to say that the $25,000 is going to stick through the end of the year. With the elections, they could still change that by the end of the year, just like we did during the fiscal cliff situation a couple of years ago, when it was signed at the last minute and everything was made retroactive to the beginning of that year.
Yeah, common sense left Washington, D.C. a long time ago, so you better plan ahead. So
yeah. Well, and there's another thing that we were talking about too, is the for retired people, the IRAs and the required minimum distribution. In the past, last year, they could take their distribution and make a contribution to a charity.
Right.
Is that still something that we have an opportunity to do this year?
That expired at the end of 2013. And again, if after, since the elections, they may change that and make it retroactive again. But as of right now, you can't make that direct contribution from your IRA to a charity and have that as part of your required minimum distribution.
Right. So that means that anybody who has to take a required minimum distribution needs to be ready to do it. If they haven't done it. And if they're going to make charitable contributions, they got to do some planning on where they're going to take it from.
Right.
So another listener question was, when you're making charitable contributions, you can give, can you give stock? Can you give cash? I mean, I know the answers to these, but we're asking you.
Yes.
So, what's the most beneficial way, do you think, for people to be making donations?
Well, you could set up a donor advised fund with a local charity where you still can sort of control where you want it to go. Mm-hmm. Or you could set up a charitable trust.
And in all these
that would go to the charity after you're deceased.
Right.
And in all of these are great opportunities to do planning and, ahead of time planning. You've got to plan in advance for this stuff to work. But one of the things that we've seen in the past is the donor advised fund is a great way, especially as you're working with Joe, great CPA in town, or your tax professional, to be able to have the ability to, let's say here in the middle of November, make a charitable contribution and have the money go into the donor advised fund, allowing you to recognize the gift, but then you can sprinkle the money out from that donor advised fund to the organization or charity or ministry that you want to make an impact on. When it's maybe a more appropriate time, maybe when there's an opportunity that you're seeing a ministry or something, an organization doing something, and it's not tied to the calendar. You've already made the gift and you can recognize it.
And gotten the deduction. Right.
Right.
That's a very good point.
Right. And because we don't know what the deductions and things are going to be for next year, we were going to talk about 2015, but let's finish 2014. Let's be good stewards of what we have this year. And we just don't know what the rules are going to change for next year. It's kind of an unknown. We know they'll change. That's a fact.
And we don't know what the rules are going to be at the end of this year either, it sounds like.
Exactly.
There's a possibility that some of those are going to change too.
Things could become retroactive to 1/1.
That makes your job really exciting, doesn't it, Joe?
It makes it difficult to plan.
Yeah, it
certainly
does.
All right, so I know we're running out of time. I got to ask Joe one more question. But very briefly, Joe, I know when oftentimes people hear us talking very technical on the radio, they get nervous. Oh, I don't want to come talk. It's a lot of stuff I don't understand. But you're willing to sit down with people as just to meet with them, just to kind of talk about what you do and get a chance to know them. They have an opportunity to get some questions answered. I know they can jump on your website and send you an email or call you, but they don't need to be intimidated about that first meeting, right?
No, definitely not. Definitely not. And typically what I like to do is sit down with the client or potential client and go over their situation, and my initial consultation is gratis.
the same price as the book we're trying to give away.
Exactly.
Free. And you will love Joe. I've known Joe a long time, and he's still my friend. So, Joe, we thank you for spending your time with us on the radio here today. We hope you and your family have an awesome Thanksgiving. And throw out your contact info one more time. And you can find his info on our website, journeyswithjoni.com. But give it one more time, Joe.
800 South Osprey Avenue, Sarasota, 941-366-3600. And thank you, Joni, and thank you, Mark, for having me today.
Thanks for being here.
Absolutely. That was fun.
Yes, it was.
We'll have to have Joe come back again.
Yes, we will.
Yes, we will.
But how they get this free book?
Well, if you want to get the free book, The Treasure Principle, written by Randy Alcorn, it's a giveaway the month of November, but you have to ask for it. www.journeyswithjoni, that's JONI.com. Or you can give us a call at 941-361-1484. Journeys with Joni. We'll be back next week. Until then, thanks for listening.
This program is for informational and educational purposes only. This program is not a solicitation or recommendation for any investment or security. Investments or securities mentioned in this show may or may not be owned by NEPSIS Advisor Services. NEPSIS Advisor Services is an SEC-registered investment advisor.